Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're discussing a report on the Toronto area new homes market, which has just seen the worst February on record. Nearly 17,000 new and pre-construction condo units have gone unsold. That's a significant number, Janine.
It really is, Steve. It's heartbreaking to see so many homes without buyers, especially when housing is such a critical need. The report by Altus Group, commissioned by the Building Industry and Land Development Association, highlights the ongoing challenges in the new home sphere. It seems that potential buyers are still hesitant, likely due to the high prices.
Yes, the benchmark cost for a condo apartment is still around $1 million. Although that's slightly down from 2024, it's barely changed compared to January of this year. The economic uncertainty and high building costs are certainly playing significant roles here.
Absolutely, Steve. And let's not forget the emotional side of this. For many, owning a home is a dream. But with the benchmark price requiring a 20% down payment of over $200,000, it's a daunting task for most families. It's a lot of money to set aside before even considering mortgage payments.
Right, and the numbers from last month are telling. Out of nearly 17,000 condos, only 152 found buyers. That's a stark contrast to February 2022, when over 3,000 condos were sold. Clearly, the market dynamics have shifted significantly.
Indeed, they have. And it's not just condos. The report also indicates a glut of single-family homes and townhouses. Over 4,800 remain unsold, with only 248 sales in February. These numbers are concerning, especially as the millennial generation starts looking for more space for growing families.
And with single-family homes priced at about $1.54 million, a 20% down payment would mean setting aside more than $300,000. This is a market where high building costs lead to smaller unit sizes to keep prices within reach, but it's still challenging for many.
It's a tough situation, Steve. But there's hope. Justin Sherwood from the Building Industry and Land Development Association mentioned potential bounce back as the year progresses, with factors like federal campaigns and talk of tax reductions. It's a waiting game, but one that requires attention from officials to prevent future supply crunches.
That's a great point, Janine. The industry is at a critical juncture, and while challenges remain, strategic actions could lead to improvements. We'll keep a close eye on how things develop in the coming months. Let's move on to our spotlight today, focusing on the Canadian Mortgage Rates and Renewal Guide. It's 2025, and mortgage rates have been fluctuating rapidly across Canada. This is largely due to the Bank of Canada's interest rate decisions, economic conditions influenced by U.S., tariffs, and inflationary pressures.
That's right, Steve. For anyone who's renewing their mortgage soon or thinking about refinancing, it's crucial to understand how these factors could impact them. The Bank of Canada recently lowered its policy rate, which caused prime and variable mortgage rates to fall. However, the situation is a bit more complex when it comes to fixed-rate mortgages.
Exactly, Janine. Fixed-rate mortgages are tied to bond yields and what investors are willing to pay for them. After years of high interest rates, fixed rates have begun to drop. Variable rates, on the other hand, have been more unpredictable, directly linked to the Bank of Canada's policy rate changes.
With the recent economic uncertainties, especially from U.S. tariffs and recession risks, Canadian lenders, including major banks like RBC and TD, have reduced their discounts on mortgage rate pricing. High-ratio mortgage rates have dipped below the 4% range, while most 5-year fixed rates on conventional mortgages hover around the mid-4% range.
And let's talk about how these interest rate changes affect homeowners. When mortgage rates go up, buying or owning a home becomes more expensive. Higher interest rates mean higher monthly payments, which can reduce what a family can comfortably afford. Conversely, lower rates can make monthly payments cheaper, sometimes driving up home prices as more Canadians can afford higher payments.
That's a very real concern for families, Steve. The Bank of Canada's decisions are crucial because they set the prime rate banks use for determining variable mortgage rates. If you're on an adjustable rate mortgage, your payments can increase if the BOC raises rates to control inflation and stabilize the economy.
Absolutely. While monthly payments on a variable rate mortgage remain unchanged, the proportion going to interest versus principal can fluctuate with rate changes. It's essential to choose the right type of mortgage that matches your financial circumstances and risk tolerance.
And there are options, like fixed versus variable mortgages, each with their own set of benefits and risks. Fixed mortgages offer predictable payments, while variable ones might start with lower rates, but can increase if rates rise significantly. Adjustable rate mortgages adjust periodically with the prime rate, which can offer flexibility without the risk of negative amortization.
Pre-approvals can also help. Locking in a rate or discount for a certain period can protect you from rate hikes before you finalize your mortgage. And if you're renewing at today's higher rates after being locked in at lower ones, refinancing or other options might help manage payment shocks.
That's key, Steve. Understanding other mortgage options like open versus closed mortgages or short-term versus long-term can make a difference. Open mortgages allow extra payments or early payoff without penalties, while closed mortgages have lower rates but limit extra payments. Shorter terms usually have lower rates but less stability, while longer terms offer more certainty.
And then there are hybrid mortgages, allowing for a mix of home equity lines of credit, fixed, and variable rates. They offer a balance of risk and potential savings. Options like blend and extend or blend and increase can help manage costs or access equity without breaking your mortgage.
If your lender won't renew your mortgage due to missed payments or credit issues, it's important to explore solutions like finding a cosigner, improving your credit score, or consolidating debts. It's a challenging situation, but there are ways to navigate it.
Absolutely, Janine. The real estate market trends in Ontario and across Canada show stability in some areas and growth in others. Cities like Toronto and Ottawa have seen renewed sales activity, and despite affordability concerns, the national market shows signs of recovery.
Yes, and recent changes, like the increase in the insured mortgage limit and the removal of the stress test for mortgage transfers, make it a bit easier for homeowners. Understanding these changes can help Canadians make informed decisions about their mortgage options.
Looking ahead, mortgage rate forecasts suggest potential easing if the Bank of Canada lowers its policy rate. However, ongoing tariff risks and economic uncertainty mean it's wise to lock in rates early. With many mortgages maturing soon, staying informed is key to making the best financial decisions. Our next topic is the projected rental supply gap in Ontario, which is expected to surpass 200,000 units over the next decade. According to a report by the Federation of Rental Housing Providers of Ontario, in collaboration with Urbanation, despite recent increases in purpose-built rental projects, the supply is still not meeting the rising demand.
That's right, Steve. It's quite alarming to see that despite efforts to increase the number of purpose-built rentals, we're still facing a significant shortfall. The report indicates that demand is expected to outpace supply by approximately 71,000 units in just the next 5 years, with an additional 136,000 units needed by 2034.
And this shortfall is due to several factors. Although the federal government has reduced immigration and temporary foreign worker targets, which might slightly reduce short-term demand, it does not undo the impact of years of high immigration. Over the past 3 years, Ontario has seen over 1.3 million newcomers contributing to the rental supply deficit.
It's a complex situation, Steve. The report points out that the deficit grew significantly during the years of high immigration since 2021. While the province saw a boom in rental projects in 2024, With over 50,000 units added, the vacancy rate remained tight at 2.7%, showing that the market is still under pressure.
Exactly, Janine. The condo market also plays a role here. In 2024, condominium starts dropped by 25%, and over 2,800 projects were canceled. This is largely due to a decline in demand influenced by rising interest rates as the Bank of Canada adjusted its monetary policy post-COVID.
Even purpose-built rental starts saw a decline in 2024, falling by 5%. It was the first annual decline in rental construction activity in 11 years. However, the report suggests that while purpose-built rental construction might eventually return to growth, the condo market is expected to remain under pressure due to its reliance on private investors.
The report estimates that without tariffs, purpose-built rental starts could total approximately 174,000 units over the next decade, which would be a 53% increase compared to the past 10 years. But the condo sector is projected to see a 40% decline in starts, showing a stark contrast between the two markets.
And while there's hope for purpose-built rentals with potential government incentives and lower interest rates, many of these projects still face challenges like high municipal fees and lengthy approval processes, which add to development costs. This is an area where more policy intervention could be crucial.
Policies like the Housing Accelerator Fund and removing the goods and services tax on purpose-built rental projects aim to encourage more development. But the report suggests that more dramatic actions, such as waiving development charges and property taxes, could be necessary to spur sufficient growth.
It's clear that while Ontario has made progress in growing its pipeline of future rental projects, the outlook for rental demand indicates much more work is needed. With projections showing a continuing deficit, strategic and effective policy measures will be essential in addressing the rental supply gap.
The Bank of Canada is currently grappling with the decision of whether to cut interest rates further amidst the rising uncertainty of a potential trade war with the United States. Recent minutes from the bank's March 12th meeting indicate that the decision to hold off on further cuts was largely influenced by these uncertainties.
That's right, Steve. It's interesting to see how the bank is navigating this complex situation. They noted that Canada's economy had a strong finish in 2024, with robust growth and inflation rates near the 2% target. However, the outlook for early 2025 has weakened due to increased caution among consumers and businesses.
Exactly, Janine. Surveys have shown a significant pullback in spending and investments as fears over broader tariffs loom. According to BMO economist Benjamin Reitzes, the bank is cautious about further cuts due to rising inflation pressures, which are tied to tariff-related cost increases and a weaker Canadian dollar.
And it's not just about the numbers, Steve. Inflation, particularly with February's unexpected sharp rise, remains a primary concern for the bank. While softer domestic demand could offset some of these price pressures, the bank is keen to prevent temporary tariff-driven price hikes from turning into widespread inflation.
Oxford economics economist Michael Davenport suggests that the bank might pause to balance the economic impact of trade disputes against growing inflation risks. He noted that although the Bank of Canada might be done with cutting rates for now, there is still a possibility of a couple more 25 basis point cuts this year if tariffs are scaled back.
It's a delicate balance, Steve. The bank doesn't want to push the policy rate below the 2.25% to 3.25% neutral range unless absolutely necessary. They are trying to weigh the negative impact on economic activity from the trade war against the risk of higher prices.
The Governing Council also highlighted the weaker than expected U.S. growth in late 2024, especially in business investment. Although consumption remained strong, sentiment surveys showed increased caution among U.S. households and businesses in response to trade policy announcements.
And with tariffs driving up business costs, Steve, there's pressure on inflation. The weaker Canadian dollar, along with tariff-related disruptions, has already raised costs for imported machinery and goods. Businesses are facing new expenses, and some early signs of these costs passing through to prices are emerging.
The bank is also monitoring inflation expectations, which have edged up since January, largely due to public awareness of potential tariff-related price increases. the bank committed to closely watching for any signs that these expectations could become unanchored.
It's a complex situation, Steve. The bank's decision not to provide forward guidance reflects the complexity of the risks and uncertainty over how the trade conflict will impact both inflation and economic activity. It's clear that the bank is proceeding with caution as they navigate these challenging waters.
Equifax has introduced a new tool called the Work Number Report Indicator, designed to assist lenders in the mortgage qualification process by providing early insight into an applicant's employment status, along with their credit report. This tool is powered by the Equifax Cloud, which represents a significant investment of over $1.5 billion in technology and data transformation.
That's a substantial investment, Steve. Equifax's new solution aims to give lenders a more comprehensive view of a consumer's financial profile earlier in the mortgage process. By integrating employment status verification with credit reports, lenders can make more informed decisions quickly, which is crucial in today's fast-paced market.
Absolutely, Janine. The Equifax Cloud's custom data fabric plays a key role here, allowing lenders to access data from over 100 siloed sources in a unified structure. This not only streamlines the process, but also ensures that data governance measures and regulatory compliance are maintained.
And for the applicants, this means a more efficient and streamlined experience. By having a clearer picture of their creditworthiness and employment status, they can potentially secure mortgage approvals faster. It's a win-win situation for both lenders and borrowers.
The integration of Equifax's technology into the mortgage qualification process highlights the importance of innovation in the financial industry. As the market evolves, tools like these can help lenders meet consumer expectations while managing risks effectively.
It's also important to note that while this tool provides significant advantages, it's part of a broader trend towards data-driven solutions in the mortgage industry. Lenders are increasingly relying on technology to enhance their services and improve customer satisfaction.
Indeed, Janine. As we wrap up today's discussion, it's clear that the mortgage industry is undergoing significant changes, driven by technological advancements like those from Equifax. This evolution is crucial for staying competitive and meeting the demands of modern consumers. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.